Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Oh, g'day, how you going? Thanks for joining us on the Smart Property Investment Show. One of the highlights of my week is standing here and recording these. I'm really fortunate that I get to navigate this topsy-turvy, crazy world that is property investment, and things seem to be a little bit more sensible at the moment after all the madness of the federal election and the fear-mongering and potential for changes to negative gearing and CGT and all this other stuff. So life moves on. Is it business as normal? Yes, it is. As usual, yes, it is. Properties move in cycles, and cycles are dictated and determined by many, many different things, one of which is including interest rates. And as you're probably all aware, there was an interest rate cut in June, the start of June. The first Tuesday of the month is when the RBA gets together and tells us what's happening, and interest rates were cut. We're now in the lowest rate environment that in recorded history here in Australia. So is it a good time to be in property? I think if you speak to the expert, they'll always tell you that if you can afford to buy, it's a great time to be in property. But things are changing a little bit now, and a lot of the investors I speak to are quite optimistic about the path ahead now that we have some stability and we actually have some understandings. And that is sort of connected in with the fact that APRA, the prudential regulation body, has indicated to the banks and said to the banks, you can start sort of not being so strict on assessment criteria. So borrowers have more power. So this is where we're at right now. And if you tune into the Smart Property Investment Show, and you have been for many years, we like to cover all bases and have conversations with investors right across the spectrum, whether they're one property, 50 properties, whether they're buying off the plan type stuff, or they're developing, or they've got particular strategies. And we like to make sure we have a look at all those different ways you can invest. Our guest in the studio today is one of these people. They're investing in a particular way. Faris Dedic. He's a property investor and he's doing some pretty interesting stuff. Faris, thanks for joining us, mate. How are you going?
Very well, thank you, Phil. Thank you for having me.
No, it's great that you're here. How's the world treating you at the moment? You happy with this world that we're in right now?
The world is beautiful at the moment. My main business is obviously brokering, so at the moment with the federal election, everything's settling down a little bit. It's been a very good start to the year.
It's good. So you're a mortgage broker?
Correct.
I want to have a chat with you today around...
Do you need a loan?
Well, you know what? I just got off the phone with my broker.
Yeah.
Then I'm trying to sort out... I'm buying a new property right now, and I'm refinancing another property, not because to extract money out of it, for the fact of it's with a lender who its rate is on the high side.
Understood.
So I won't mention who that lender is.
That's okay.
They've been a good lender to me.
That's okay. They gave you the money.
They got it when I needed it, and life has changed a little bit for me. So
Good.
I can now... I'm getting told I'm going to get interest-only investment product for high threes potentially. So
that's good.
That sort of makes me happy. So
that's good.
It's a good time. Good
Good.
time. So
Good
I'm sorting
on
all
you.
that out, but I want to have a chat about you being a property investor.
Yes.
Are you a property investor?
Yes, I am.
What does it mean to be a property investor?
I think what it means to be a property investor for me is basically... That's actually a very good question. I haven't thought about that.
I know, either have I.
It just got rolled off the tongue.
Yeah.
A property investor is basically somebody who sees that there's upside in investing in property in one way or another. I think that the definition of what people have as their definition of upside is very, very different. Some people look at it as growth. Some people look at it as cash flow. Some people look at it as short term. Some people look at it long term. But utilizing property as, I guess, a method or a tool to grow your wealth over time.
That's cool. So I'm obviously older than you. You're a reasonably young bloke. You're listening to Faris here and you don't get to see him. I do. So you're pretty young. How old are you? 25. Okay. So, and you've got a few properties already. We'll just get into that. Why invest in property? It's obviously a wealth creation thing, but do you do it purely because you want, you got a fancy suit on, so you like the finer things in life?
I do like the finer things in life.
But is that one of the reasons why?
No, I think what it is for property investment was that very early, I guess, into my career as whatever it is that I was doing from the age of 18, I realized that a lot of the higher net worth individuals that I was dealing with in all of my jobs had a main trading business or a main source of income, and on the side they all did property. So over time you kind of learn the fact that that's kind of what you need to get into. It's not until you start exposing yourself and making a few mistakes or learning or whatever it may be that you understand how you want to invest in property. But I think it's a very good long-term vehicle over time to enable you to build your portfolio. For me, I also realized that property is an investment that you don't necessarily need to be full-time involved in. It's an investment that can kind of sit there on the side and it can grow over time. And being 25, the way I see it, worst case scenario, even if I hold on to everything, mortgages go for 30 years, I'll be 55. If I can pay everything off by the age of 55, I've done pretty well.
Happy days.
Life's pretty good. So,
and it's good that you're saying
sense.
that. You know, you're relatively young in your investment journey. The fact that you started young gives you advantages that is longer in the market.
That's right. Exactly right.
If you start a decade later or even a decade later, a lot of people don't start thinking about it when they're in their mid-40s, right?
Correct.
You potentially missed 2 market cycles. So
Absolutely,
there is a big thing about getting started. If you get started young and early, you get the benefits of that. And you might get some bad market cycles, but
Correct.
the longer you are in the market, property, if you go back through history since they've sailed a couple of boats in here in Sydney Harbour,
That's right.
property has always gone up, right?
That's
so
exactly right.
start early, start if you can. Do you have a sort of family connection with property? Your parents property investors?
Not at all.
No?
Not at all. What happened was, I think that my property investment journey mainly started when I entered in brokering. Obviously, when we first started into the industry, I'm the director of Red Door Financial Group. When we first started into the industry, I was doing mainly home loans. Now I'm focusing on commercial lending, and our team takes care of home loans. And seeing all of that exposed me to a lot of property investment. Now I work with a lot of higher net worth individuals and a lot of developers, and I do a lot of development finance. So it exposed me to it. So that's what got me into property. In terms of family, we came to Australia, I think it's about 10 years ago now, from Bosnia. It's not very traditional in Europe for individuals to invest in property. It's very normal for them to just buy one property or rent and sit there until, the day they pass away, unfortunately. But when you come here, my parents have done well. They've got an investment property for being here for such a short amount of time. And it was just one of those things that they did very early on when I was about 15. And then at the same time, through my career as a broker, it's introduced me to that world. And I want to grow it because for me, at the end of the day, at 50 years old, I want to have $1 million of passive income coming in and sit back on a yacht somewhere.
So that's the goal.
That's the goal, $1 million.
All right. You should be able to do all right on that.
It'll be good.
$1 million in 25 years, you should be all right still.
We'll see how we go.
So it's quite funny, and I'm really fortunate with this podcast. So I speak to people from all walks of life, and no investor looks the same, right?
That's right.
And there's a lot of cultural nuances that dictate people's relationship with property.
Yeah.
And you mentioned in Bosnia, so that's in the Balkans, if people
Correct.
don't know, which is sort of southern-ish Europe on the Mediterranean. Who owns all the property there? Just corporations?
That's a very good question. Bosnia
No one knows.
No one knows. I'm not even sure.
Don't ask.
Don't ask. No one knows. Not many people can afford their rent there. Not many people have more than $1,000 in their bank account. So it's a very, very different cycle as to investing in property. And organically in Europe, a lot of the properties that are built, a lot of developers will build an apartment block and they'll retain the whole stock position and they'll rent it back out. That's very, very common for a lot of European businesses, and it's generally the high net worth individuals who do that. So you've got that system in Europe, which is not the same in Australia. In Europe, the rich get richer and the poor get poorer. But in Australia, that, middle class or whoever, it doesn't matter where you're from in Australia, what sector of it, what income you have, you can start investing in property. And that's the difference.
It's a really good point, Faris, because in many ways, some people argue completely against what I'm about to say, but property is largely democratized in Australia, as in it's just not only open to the very rich to invest and take a stake in property. All Australians, by and large, I'm not being a little bit general there, but anyone who's working and has a job and is committed to path of wealth creation or looking after or being responsible for their own life moving forward, can get into it.
100%.
They can get into it. And I've had a lot of people on the podcast with, lower incomes, right, who have made a decision to look after themselves into their future and invest in property and going without, as a result of it in their early years. So you sort of kicking off into property when you're still young.
Yeah.
What are you missing out on? You're sort of sitting at home, eating your mum's cooking every night and not going out, and you got no life, or you manage to balance them up?
Not really. We're very, very fortunate that Red Door Financial Group has done extremely well in the first 2 years. And don't get me wrong, from 18 years old, I haven't worked a week in my life from 18 that I've worked less than 50 hours a week. So I've, at any one time, if you say 50 hours a week and you have a minimum wage of $19 an hour at 18, you're always going to start making a good amount of money. But I did uni full time. I did full-time work. I did full-time social life, full-time DJing at one point in my life, full-time travel, full-time. Anything I do full-time. I don't think that it's fair to say that you need to sacrifice anywhere. If you want something in your life and you want to work hard for it and you're happy to have 5 minutes to yourself and you're happy to be busy, you can achieve amazing things in Australia. And like you said, property in Australia is open to everybody. So from 18, I started, at 18, all the money that I saved went to travel. Then at 19, all the money I saved went to buying, I was selling NutriBullets. Then at 20, I started to save money. 21, a little bit more, traveled at the same time. By 23, we started a business that was capital intensive. And now the business is doing really well. So we went from, I guess the biggest thing that we sacrificed on, or it's not necessarily a sacrifice, the biggest mentality that I've always had was don't live a lifestyle above the means that you have. and understand one thing. And I remember one of my highest net worth clients said this to me 2 years ago. He said, in Australia, everybody lives on their gross income, not their net income. So that means that in general, everybody in Australia lives 30%, saying the tax rate's 30% above their means. So that perception taught me very, very quickly to live on net. And being self-employed, you don't pay tax until the end of the financial year or until your bastard's year, whatever it may be. So that taught me very quickly, hang on a sec, I don't make X amount, I actually make X amount. I need to save 30% of net to go towards my savings. So that was probably the best piece of advice I ever got. But in terms of sacrificing, I don't like to sacrifice things in life. I never have. I'll get another job and I'll make money. What
makes you so different than your peer group? Because a lot of them would be sitting there going, this Faris guy, I'm listening to him, that all sounds like a BS. I don't believe it. I know how hard it is to be young. I can't afford property. I can't do this. I can't do that. What makes you different?
I think that that's a cop-out. I think that at the end of the day, if you want to achieve something in your life, we're very, very blessed in Australia that even if you go do whatever it is that you want in your life, there is a minimum wage. Where people need to start sacrificing is the fact of the matter is you can go out every weekend, Friday, Saturday, Sunday, but get a second job to do that, and your first job, save it. Stay with your parents as long as you can. Don't get credit card debt. There's a lot of our first-time buyers who our team deal with. A lot of people go into debt, don't live above their means. The difference with me is that I think the mentality that I learned was that when my parents' education is very important to my parents. When my parents moved to Melbourne, they put us in a suburb that is in a zone school that's not the cheapest suburb in Melbourne, let's say. So everyone around me, 18 years old, was getting a Louis Vuitton wallet for their 18th birthday, and I didn't. And I think that gap kind of pushed me initially to start making money and wanting to, I guess, hustle. But over time, you realize that money is definitely not the most important thing in your life. It's just a tool. It's just a vehicle to invest over time so that one day at 55, that money and those sacrifices I made now will eventually make me time.
So you're talking about, I guess, spheres of influence with you. The job that you're doing sort of exposes you to maybe a different group of people who you normally wouldn't have a relationship
100%.
with. What are your mates that you grew up with sort of, are they sort of doing what you're doing? Are they thinking the same way you're doing, or are they sort of see the world different?
They don't do what I do, nor do I know a lot of people who do or work as much as I do at my age, For me, a 80, 90-hour work week is normal. I don't know any better. I've never known any better. Even during my exam periods at uni, I didn't take time off to study. I worked the whole way through. And if I had to stay up until 2 o'clock in the morning, I would. Last night, I was in a hotel room here in Sydney. I'm from Melbourne originally, obviously. I was working till 2 o'clock in the morning. I spoke at a conference yesterday. I came back from the conference, I ate, and I worked till 2 o'clock in the morning. But what else am I going to do? Go out for a coffee? No, I'd rather stay here and work. I don't watch TV.
What keeps you so focused though? Like why? You got to just, a lot of people say, you got to slow down, mate, relax, take it easy.
Everybody tells me that.
Yeah. So,
but I'm not tired. I'm not stressed. I take care of myself.
But why? Like really, you're hunting this sort of $1 million passive income at 50.
It's not even that. I don't.
So why then?
I thought initially that my drive came from money. Money got me into doing what I'm doing, but I realized very, very quickly that I actually love the grind. I like being busy. And money is thankfully a subsequent part to what I do, but I like being busy. I don't like sitting on the couch watching TV. To be honest with you, I don't know how to do that. If I sit on the couch, after 10 minutes, I'm like, all right, done.
Do you find time for love?
I have a girlfriend.
Yeah, I
have a partner. She's beautiful. She's very understanding, but...
Is she cool? Is she going, yeah?
She's cool. She's cool. She's very supportive, She understands the kind of person I am, but I compartmentalize my days. If I'm at work, I'm at work. I don't sit on Instagram or Facebook or social media or Snapchat or Google things. If I'm at home, I'm at home. If I'm on a plane, I'm on a plane. Whatever I do, I'm extremely focused.
So tell me some of these influences, because I'm listening to you and it feels to me, it would appear to me that you've probably got some mentors or some people who sort of help shape the way that you think. Is there anyone in particular? You don't need to name them by name unless they're... I
didn't have a mentor or a impact into the way I run my life until 3 months ago, when we hired an interim general manager for our business to help us grow and structure it. Being 25, I don't understand how corporate structure's meant to work. I've never worked in corporate. So we got a gentleman called Michael Trencher, who's a fantastic...
Michael.
Trench. He's a fantastic
Oh,
consultant.
if you listen to this, Michael, how you going? I didn't realise. Yeah, geez,
See you next
go.
week, brother. So Michael's an interim, pretty much an interim GM with us at the moment. He's helping us, and he's coach. He's like a fill-in dad for us in the business, and he helps us structure the business the right way and understand everything, the way it's working, and how we should structure our human resources, etc. But in terms of that, it's not really influences. I can't say anybody's influenced me. At 3 years ago, I was working in a burger shop. The guy that I was working with there, he embraced how different and unique I was, and he pushed me and said, never change. And I think...
Were you good at selling burgers?
I can sell anything.
Yeah.
I can sell anything.
How do you sell a burger? Just make sure the quality's good. And sell
how you sell anything is you need to put yourself in the shoes of the client and see what they want. If you understand that, then you can literally sell anything. And I don't want to say that in a sleazy way. It's not like I manipulate people to buy. I just understand where their needs are and what they want, and just give them what they want.
I always find it entertaining, this Smart Property Investment Show, because just chatting with people, there's always like 2 or 3, there's 1 or 2 degrees of separation. The fact that Michael,
Trench,
it's I find it quite entertaining. But just on that point, very mature of you, in inverted commas, because you're relatively young in age, to work out where you didn't have a set of skills and you've gone out and found those skills. And I think that really works within the context of property investment. The best
100%.
property investors I know are those that say, I'm not an expert at this, but I know there is someone who is an expert at it, and therefore they will pay for that advice. So a buyer's agent, for example, or even a mortgage broker. You don't have to pay for a mortgage broker; they get paid differently. But buying expertise is absolutely critical. So let's have a chat about your portfolio. What is it? Where are your properties? What's your sort of strategy?
My strategy is to hold and build cash flow over time. Like I said, I'm not a kind of person that buys and sells, nor do I need to buy and sell, nor do I have any obligations. I don't have any children. I have a dog, but mum takes care of it, so big deal.
What sort of dog you got?
I got a cavoodle.
You got a cavoodle.
Big. If you don't have a dog, it's a big responsibility. I'm not sure about that, but thank God mum took care of it. I don't have any obligations in my life, so for me, I can afford whatever repayment comes in. But I'm very strict upon, I want to see growth not in 2 years, 4 years, 5 years. I want to see growth in 20 years, which pretty much over time, a couple of cycles up, we'll get there. And if not growth, I don't really care if the property drops by 30%, because if it's dropping by 30%, it means credit's getting tighter, the market's changing, there's a change in the economy, or there's a change of whatever. If it starts dropping, my yield will increase. So I look at what's going to make me money and give me my cash flow at 55 years old, so that I can wind back a little bit and spend time with whoever I want to at that point in time.
So where are your properties? What do you got?
Queensland, I have one in Queensland.
Yeah.
My owner-occupied property, I'm actually moving out now. I settle in July.
Do you live in Queensland, do you?
No, I live in Melbourne.
You live in Melbourne, okay.
Yeah, so I live in a suburb called Baldwin, in an apartment there. I didn't want a huge owner-occupied property, and at the same time, the property that I bought in Baldwin, that apartment, I only bought it because I could fully offset the loan.
Okay.
So it doesn't cost me anything. Everything I buy is P&I. I don't do interest only, for example, because my intention is to pay that down. So in Queensland, I bought a site in Kalinga, which I'm going to flip into a medical centre.
Okay. Whereabouts in Kalinga is it?
It's on the Old Gympie Road.
Okay.
So
I've got a properties up in Kalinga.
There you go.
Yeah.
So
everyone's buying Kalinga. It's a good spot.
It's a good spot. Get into it. So Kalinga was really, really good. Next, so where we're a little bit different, or where I'm different, is I don't have time to necessarily hunt properties. So we syndicate.
Okay.
And we'll syndicate now. We're looking at, for example, 40 lot subdivision, which we'll syndicate, myself, a real estate agent, a builder, and another investor. We'll flip that. We'll settle on it. The next day we'll settle the lots and make money and roll it.
Good.
So
a little bit riskier, a little bit more technical, and a few more moving parts than your average investor.
Very technical, but like you said before, you find people who specialize. I can finance that. I know I can finance it. I have a certain way of settling it. I deal with, my average commercial transaction is $5-7 million within the business. So I understand that level of debt funding, but I don't specialize in infrastructure. So the builder's involved and he's a part investor. I don't specialize in selling the lots. So we have a real estate agent involved. So instead of buying, I guess, knowledge, it's part of the project. So that's how we work.
So you said you used a buyer's agent for some of this stuff?
Kalinga.
For Kalinga. Okay. Were they good buys, Adrian? Don't tell me who they were, but,
They were good.
I'm sure I know them, but I'm not going to give anyone a free plug on this thing. No.
They were very, very good in terms of the point where I said, this is where I'm at, this is what I need, this is the kind of property I want, and get it done.
So they bought you a splitter block. Is that what you got there?
No, it was just a house.
Just
it's a resi house.
Okay.
Resi house,
Yeah.
good location. Then I started working it out because it's a 700 square meter block. And then I started working out the price per square meter, and I was in shock because you can't buy in Melbourne price per square meter.
Even
Like
close to
it's
that.
impossible. And not just that, one, price per square, second, yield. I can't believe the yield up there. It's ridiculous. Third, the actual entry price point is lower than any other entry price point I've seen. And it's in the growth corridor, and it's in Queensland, and it's close to Brisbane. You can't really ask for much more when you buy a property. So they just sent me one photo of it, and I sent a text back and said, done.
Yeah.
Go for it.
Good.
But at the same time, you need to have the money there when you get opportunities like that.
So what is, for you to generate $1 million a year in passive income, what does your portfolio need to look like in order for you to do that?
50 properties, 20 grand a year.
Okay. Is that it? Yeah.
It's not much more.
You only want 50 properties completely unencumbered that delivers 20 grand a year.
Yeah. Or whatever.
The maths is simple.
It's not rocket science.
Well, you've got 25 years to sort it out, and you put in that. What's that?
Maybe get another 5 properties with 20 grand a year to cover your land tax and et cetera, et cetera. But you want $1 million a year. It's not illogical, and the yields are there. And you have that perception that I have right now is based upon current yield and current valuations. Who knows what it'll be in 20 years?
That's right.
I'm not sure.
So 50 properties, what would they need to be worth as a total size of the asset base in order to generate $1 million?
If you're looking at
So if you get 5% is $1 million, that's a big portfolio.
yeah, you're looking at about 20 mil.
Yeah, it's a big portfolio.
20 mil, which sounds like a lot, but what you realize very, very quickly is that, or if you're in finance at all, the faster you amortize your loans, which is paying them back, the less interest you pay. Interest over 30 years almost always equates to, at the interest rates we are now, almost always equates to how much you initially borrowed. So if you can pay back those loans fast, then whip them back.
So you're just benefiting from the power of leverage, really, which
100%.
is really a light bulb moment for a lot of people in property investment when they actually understand what leverage is. 'Cause a lot of people don't get it. What's leverage mean?
Crucial.
What is it for people who
For
are sitting
me?
there? Yeah. Tell me about leverage.
For me, leverage, I'm a little bit different. One is you can look at it on an equity play position, but I look at it on a cash flow position. So if my loans are P&I and if this property is paying itself off, any surplus cash coming in from that property goes back into the facility, which pays the facility back over time. When that loan to value ratio of that property drops to 60%, I'll pull money out of the redraw and I'll put it to a new property. And it does the same thing. And then what happens over time, because the interest costs and the repayments start coming down on that property that you initially bought, that rent then turns into covering the next property. So let's say, for example, you buy a 400 grand property, you put 80 grand in plus stamps, you put 100 grand in, you have a 320 grand mortgage. If your rent's 20 grand a year and you've paid that off and you've done that again, all of a sudden you got $40,000 a year of rental income across 2 properties coming in to cover the second mortgage. 40 would take you 15 years to pay it off. You go again, now you got 60 to pay off the third. You go again, now you got 80 to pay off the fourth. You go again, now you got 100 to pay off the fifth. 100 grand a year of income to pay off the fifth property at $400,000 acquisition. You're done. You've paid it off in 4 years. So once I get my, $500,000 a year of rental income, I can go buy a 500 grand property and pay it off in cash within a year. It's the reality of it.
Yeah, it's leverage,
That's leverage.
So would you say that, and I'll close with this question, do you think that your approach to property is risky?
No, because the market can do whatever it wants. So long as people need a place to live and need a roof over their heads, I'm okay. I don't care what I sell it for because I'm never going to sell it. That's the reality of it.
Well, let's hope it's always blue skies for you.
Let's hope so.
Do you think about things getting hard? Do you plan for if things might go off the rails? Or
I do plan if they go off the rails, and if they go off the rails, I'll start looking more into commercial assets that are more stable. They don't grow over time but have higher yield. Commercial lending rates at the moment are very similar to home loan lending rates. Yield's higher, and then some commercial properties you can get 90% no LMI. There is no LMI if you get it the right way. So there's always a way to invest in the market, and there's always a gap in the market. You can go buy a caravan park. You're still going to get yield. At the end of the day, it comes down to property is my method of building cash flow and yield. That's my preferred method. Some people do it other ways, but there's always something in the market that will give you yield.
Faris, thanks for coming in and
Pleasure. Thank you, Phil.
sharing your journey through property. And it sounds like it's a relatively new journey. You've got some way to go, but it's pretty clear that you know what your goals are, and you've set your objectives, and it's whether or not you can stay the course and keep at it. And you're hungry, which is a big part of it. And hunger is a good thing, right? You need to find out. Everyone's got different sort of hunger.
It's got pros and cons. That's it.
Everyone's got their different sort of hunger, and I think unless you can actually find, as a property investor, what actually makes you tick and where that hunger lies. And for a lot of people, hunger is, I want to pass on a big property portfolio to my children so they can have a better life than I do. Other people going, they want to make $1 million and sit in the yacht and stuff. And that's cool. It doesn't matter. It's irrelevant. It's irrelevant what it is for you. It's better your own choice. So thanks for coming in, mate, and let us know. And we'll get you back in once you sort of ticked off a few more things, and we'll see how you're going. We'll see how you're going.
Thank you, Phil. Appreciate it. Thank you.
Thanks, Faris. Remember to check out smartpropertyinvestment.com.au. If you're not yet subscribing to our daily morning newsletter, so you're the first to know what's happening in property and property investment, smartpropertyinvestment.com.au/subscribe, or go to social media. That's where a lot of people connect in with Smart Property. If you like what we're doing with the podcast, get in touch with the team. You're more than welcome to come on. Faris, it's pretty easy. Just straightforward.
No stress.
No worries. No stress. That's good. And if you like what we're doing, also remember to click that subscribe button wherever you're listening to this. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.